Maybe first I will be the host as the minute, and welcome our speakers. Maybe you can have a very brief introduction of yourselves.
Hi everyone, Kate here from Morph Network. Morph is a putting global finance on chain and with a payment settlement layer. The project?
Your company,
Morph is an EVM L2 based on Ethereum, and we have sub 300 millisecond finality, and we're working with a lot of different custodians like wallets and institutions, on-off-ramp, neobanks, crypto cards, to become their backend settlement rail for hopefully one day all of the entire global finance to happen on chain.
Hey guys, it's great to be here. My name is JJ, co-founder of Asseto. So what we do is we are a RWA platform. We help a lot of financial institutions to tokenize their assets. Right now, it's been a year since we've launched, and we have over 380 mil of TVL on chain already. And we work with a lot of quite top-tier asset managers, such as China Merchant Securities, Shanghai Pudong Development Bank, China EMC, etc. So yeah, happy to be here anyways.
Hello, this is Forgiven, or you can call my Chinese name Yuan Jie. So I'm the Chief Shilling Officer for Conflux. I've been with Conflux since day one for about 8 years. Long enough that, seeing so many people like go and pass by. So we call ourselves like China Ethereum. The reason being we are probably the only project operating in China using our real names and not in jail yet. Yeah, so that's probably how we are different with the others people. Speaking of RWA, we have been working with Ant Financial, introducing renewable energy as APAC into the market, and we successfully redistribute RWA assets through the DeFi protocols to the stablecoin retailers. That has been a very symbolic case for the RWA market in Hong Kong. That's it for now.
Hey guys, I'm Walter. I'm the head of Asia for Plume. We're RWA-focused chain, of which we have originated the Apollo A-Creds, the Invescos, the UBS of the world. Our current focus is really around how do we enable permissionless but compliant distribution and form the what we'd like to call on-chain capital markets. So thank you guys for having us here today.
Okay, thank you. And I want to have a question to ask for you all. For RWA to be the new infrastructure, it must be provide a marginal utility that the legacy system cannot, like 24 hours every day, automate settlement or hyper composality. If we move the crypto hype, what is one technical or economic features of your project that makes the legacy financial system look obsolete? Maybe from Kate?
I think there's many, but if I have to pick one, it has to be near instant settlement, where the blockchain can really process things much faster than the traditional rail. Not in the single transaction sense maybe, but in terms of stacking up transactions, interoperability, where you maybe buy a fund in an account right now, you cannot instantly get that to be a collateral for your perp position, for example. But if you change that to on-chain rails, you can instantly do that, removing middleman's approval, removing exchange gatekeeping limitations where there's no very little geographic restrictions as well. So I think near instant settlement sees it all, but that term actually include vast implications following what we can do with your position or tokenized asset.
Sorry for the lateness. I'm the moderator. I'm an investment analyst at J Square, early stage Web3 VC.
We've done it already. Question one. Oh, okay. Yeah. So if I have to name like one thing has to be named. I I'd go with programmability. So with everything, it will be able to be written into the code, and the rules and everything can be traveled with the assets. So it will be quite clear that who originate the assets, who can do the transfer, who can do the operations, and etc. So everything will be really clear with the programmability. And now we see TradFi sector and the DeFi sector is getting emerged. So we see a lot of opportunity that if everything is codable and it can be tracked to its original source, it will be easier for everything to go starting from today, moving forward. So yeah, I'd go with programmability.
Okay. I think I'll go with two things. One is liquidity. For liquidity, like for some money market fund, tokenized money market fund, they have worked with DeFi protocols or subscribers. Basically, if you send USDC into the protocol, they will, in return, give you the money market fund token like immediately. And if you try to redeem, you burn the money market fund token, and they will give you back USDC within 1 hour. That's actually even quicker than T+0, right? That's like within an hour, you can get the liquidity you want. And it's all automatic. That, to me, is something cannot be done by the TradFi. And the other thing is probably the distribution and also the entry bar is becoming permissionless, and the entry bar is very low. For example, for the the green energy asset pack that we wrap into the DeFi protocol on Conflux, that DeFi protocol basically provides a Morph, like a platform that people can basically deposit their stablecoins into the RWA assets and enjoy a 8% yield. And they can, they don't have to KYC, and there's no a minimum bar for you to have to deposit. You can deposit $10, $20, and you can be from everywhere of the world and enjoy 8% yield, with a 3 months lockup. And if you want to have that, in the traditional, securities venues, that could be complex, right? So I think, and basically, it helps the asset owner to access capital from all over the world. So it basically reformed the way of distribution, and also it changed the way people participate. So that's the second part. I think the distribution changes. Thanks.
I think to just build on what you guys mentioned before, a very simple rule of thumb from my perspective is if asset issuers care about one thing, and fundamentally that's distribution. And so from that perspective, I think when you think about how can you do things in a permissionless but compliant manner, I think to all of your points prior, that's where you can enable a lot of composability, a lot of the net new use cases, such as looping strategies, etc. I think at Plume, we kind of take it from the perspective of what does the overall stack look like? How do we design this in a manner that any asset issuer can basically plug in and then distribute, whether it's brokerages or otherwise? But so I think maybe a bit of a cop-out, but that's the prerequisite, so to speak.
Got it. I guess moving on to specific questions for speakers. Here's one for Kate. The Lindy effect of the legal system is much stronger than a blockchain. In an event of a default for an on-chain credit asset, the smart contract is powerless against a physical court order. How is Morph building infrastructure that doesn't just record payments, but actually synchronizes legal finality on-chain?
I think I'll start with not just Morph, but blockchain generally. I think right now we're still in a position where the tokenized part happening on chain, it's a little bit separate from the legal part of what happens if things do default and the remedies you have available to get your potential money, if any, back. That happens in real life, which includes our legal system. That can't really happen on chain yet. But at least the future I foresee is that we don't just have a distributed ledger for transactions. We also have a distributed ledger for legal system, where maybe an oracle can pick up a result of a court case, and then it can be streamed on chain, just like prediction market events, and then that can trigger remedy distribution of assets with involved of the fund's trustee, their legal team, possibly signing multi-sig. I know this might sound crazy right now, just as prediction market probably sounded a few years back, but I do believe the whole ecosystem as a whole, not just Morph, is building towards that direction. And in terms of coming back to Morph a little bit, right now we have settlement that happens on chain. We have a lot of custodian partners like Fireblocks, where they plug in their treasury management and safety toolkits that happens on Morph, and also oracles like Redstone that provides proof of reserve, where the underlying tokens assets, collateral price, or how much they're holding is streamed on chain every 10 or 15 minutes. So we're moving there, and then our tech team is working relentlessly to make sure if this happens, Morph will be one of the first players that make sure the legal rails also happens on chain.
I guess a specific question for Walter. A common critique of RWA change is they create liquidity silos. By building a specialized chain with Plume, what are you solving? Are you just fragmenting liquidity, or are you solving a desperate need for the broader DeFi ecosystem?
So I'll give you an example, right? So for the Apollo A-Cred asset that we originated from Securitize, there are a variety of different wrappers for the fund. For any given fund, who is the tokenization provider, and what is the version that comes onto your chain or elsewhere? I think all of that is to kind of say liquidity, or where liquidity is concentrated, is definitely a huge problem within DeFi. I think the approach we've taken at Plume, so as an example, Nest, which is our in-house vaults protocol, it basically functions to originate all the assets that we bring in. Even though Plume as ourselves, we have a chain, we've actually deployed Nest onto other chains, specifically, hopefully to help with some of this. In terms of fragmentation across DEXs, lending markets, everything else, I think the core assumption is that with efficient market pricing, or as an example with market makers, you would have it arbitraged out. However, I think the core approach that we take that kind of enables all this, which I touched on before, making sure that everything is sort of following a certain set of rules in terms of a compliant but permissionless stack. That enables you, with the A-Cred example I used at the start, to have the same implementation stream through layer 0 OFT or otherwise. Let me know if that sort of answers your question. Yeah.
Got it. I guess moving on to a question for JJ. Yield is a magnet, but composability is the engine. Many RWA tokens today are dead. They sit in wallets and can't be used as collateral. With your experience scaling TVL across protocols, how does Asseto ensure that a tokenized bond isn't just a static asset, but can be seamlessly integrated into restaking, money markets, and liquidity provision without introducing systematic risk?
Okay. It's actually a really good question. So let me give you guys an example. Like before I got here, I was with a guy from Pando. So I took this guy to one of the top asset managers in Hong Kong. And these people are from like different world, basically. So they don't, the TradFi guys, they don't understand what PTYT is. But with us as an intermediary, and we provide middleware, in that way, we can actually bring the top traditional finance products on chain, and then also we can integrate them organically into the DeFi sector. For example, like Pando is like one of the top protocols we see in this cycle. And we can actually break up this, pretty traditional stuff into PT and YT, and then provide the on-chain users with the top yield, like top-notch yield the industry can actually provide, especially with the market right now, like with the market drawdown right now. We see a lot of, no matter on Aave or other lending protocols, we don't see a lot of yield coming out. And we don't see a lot of borrowing demand. In that way, like, you just can't get that much yield. And what we do is we can actually bring the best-in-class assets and the yield, various of yields on chain, and then we can integrate them into the DeFi sector, and just merge those two worlds together. So we figured if that's not value add, what is? So yeah. So and that's just a starting point. So we're getting there. Yeah.
Got it. I guess a question for Forgiven from Conflux. In your experience with endowments and fund of funds, what is the deal breaker that prevents institutions from moving onto a public L1?
I think there are two things. So first is like compliance issues, right? For example, in Hong Kong, for every RWA assets issued on a public chain, they have to go ask permissions of SFC, right? And for chains choices, options, they probably say, okay, Ethereum is okay, and Solana is doing the lobby. And for Conflux, they say, oh, who is Conflux? Probably it's a shrimp. Is it secure enough? The market cap is so low, right? So sometimes because it's a compliance business, so they may have issues with the, like the L1s they are working with. That's one thing. The other thing is once institutions and banks, they move to L1, okay, that actually changed the entire system of accounting and their finance systems. How I'm gonna book the stable coins, the RWA assets I hold on chain. Is that auditable? Is like a CFA or like ACCA or like ACA, all this accounting system can be, like part of the crypto business. I think it's still far away from, like incorporate the crypto world into their accounting systems. And now things becoming better after some custody firms becoming compliance, and they use the custody reports as of the evidence for their accounting systems. But that also could be an issue, right? And the third thing is actually the custody itself. For, let's say, if you hold assets on-chain, not at exchange, what's your wallet? Is that a custody wallet? Is that a multi-sig wallet? Is that an MPC wallet? Now, how is the internal control can be maintained by the finance department? What if it's an EOA account and your accountant people just lost the private key and all the assets is gone, right? And that could be horrible, right? So I think there's a long way to go for like institutions to really participate on the on-chain systems. So I feel like right now the institutions are more on the sell side instead of the buy side of the on-chain, like on-chain portfolio management. Moreover, it's more like a hedge fund, exchange, or crypto native people are holding assets on chain, and they care less about the accounting systems. And yeah, so it has a long way to go. Yeah, that's my 2 cents. Thank you.
Thanks for that. One question for JJ is, when people buy RWAs on chain today, most people just buy and sit on it. As yield infrastructure, how do you solve this problem? The idea that an asset is liquid on a DEX but has 0 buyers when a large buyer needs to exit a $50 million position. How do we move from static tokens to productive collateral?
I have it. Yeah. So I think it's a question more about how to exit freely, and also it's a question about liquidity. So yeah, as we all know, like we now have 29 billion of tokenized assets on chain already till today, and it's actually not a small number. So we do have a lot of real world assets brought up on chain, but many of them are sitting idle, and also there's no secondary market. So that is why people having concern, how to exit freely if they have 50 mil and they want to get out. Like, how do we do that? So we actually orchestrated a solution for this specific problem. So the way to go is we are working on this smart router so that other than the primary minting and burning process, primary subscription and redemption process, users can actually get instant liquidity through the secondary market through our smart router. So for small amount of redemption, it's easy. You can just go to the AMMs. You can just go to Uniswap, PancakeSwap, for example. If you have like medium or large liquidity necessity, if you have to get out, then we have RFQ. The reason we have RFQ is because if we don't provide them with a very stable price when they get out, the market makers would just not join this party. That's why we have RFQ as a middleware. And for any size of amounts larger than that, we have primary redemption, which is pretty straightforward. You just get the assets outside of, assets out of the underlying assets. It's pretty straightforward. And for many of the assets we brought on chain, like the liquidity is pretty sufficient. So like T+1 or T plus couple days, like T+7. Which is very tolerable for many of the on-chain investors already. So that's how we structure it, like a layered waterfall mechanism so that users can just exit in the way they prefer. Yeah.
Got it. Thanks. I guess a question for Walter from Plume. Plume talks a lot about RWA-Fi. Traditional finance uses rehypothecation to juice returns. In a decentralized RWA environment, how do we enable high capital efficiency without introducing too much leverage in the system that led to crypto collapses in the past?
So I think the fundamental thing of rehypothecation is basically default risk or bad debt risk. The most, one of the prominent examples is probably Three Arrows Capital and the decontagion that followed from there. Fundamentally, the question is, if I'm providing you a loan, what is the collateral and what is the value that I can get even if the asset is distressed? So as an example, with a lot of RWAs, I'll use the A-Cred fund as an example. Typically, you can actually even have someone come in that would, in traditional markets, you have someone willing to come in and buy distressed debt at cents on the dollar. Functionally, it's a little bit different from market making. It's closer to something like a credit book or a backstop. I think with that in mind, when it comes to rehypo, the core thing is really who is writing or underwriting the loans against it. You have the examples of the curators for Morpho, but fundamentally for every asset, you'd have to find the right person to essentially diligence and price it appropriately. So if everything is baked in and the LTVs are reasonable, which is a big assumption, it should be a practical impossibility for this to happen again.
Got it. I guess moving on to a question for Given. Stablecoins are very easy because the peg is easy to verify, but as we move into more complex assets like private credit and private equity, we face a massive asymmetry of information. How can blockchain native infrastructure truly verify the health of a real world loan without relying on a centralized human auditor?
Sure, I think for RWA, it really lies with like transparency, like jurisdiction, and also kind of communication. So when I say transparency, let's say take stablecoins as example. You go to any stablecoin projects, they have a transparency report. So actually when USD1 first launched, I always mock it, hey, this is Trump stablecoins. It's all endorsed by Trump's name. It's US president stablecoin, that's good. You don't need like transparency reports. So I kind of a public talk about it on Twitter and mock it. And then later on, they actually release their like transparency reports. So I think, okay, that's good. That's a good sign. At least they have transparency report about do they have enough money in the bank. So that's the same with the private credit thing, right? You have to disclose what's the underlying assets, operation status behind the private credit, right? If it's a portfolio of companies, what's the ratings of those companies? If it's a private credit pertain to, let's say, real estates, how is the mortgage compared to the property price, right? It's all coming with like healthy status. So with full transparency, the investors can judge, whether they want to pull out or they want to continue to stay in the game, right? And the other thing is, I think it's about like jurisdiction, because like in certain environment, the jurisdiction try to do their best to protect the investors. Right? You don't want to go to any emerging market. Their legal system is not well set up, and their government is not stable, right? Because in that case, their policy could change swiftly, and your investor rights may not be protected well, right? So that could be another issue. And the third thing is actually communication. As Walter just mentioned, now we have the roles of curator emerging from the Morph platform, right? All those curators should do their jobs to clarify and elucidate what are the underlying assets they actually have their investors into. We see the USDX blows up. Many of the curators are actually in trouble. They didn't do their jobs, and they didn't do the communication. I mean, in the traditional world, like all companies have this quarterly financial costs. What do we have? Probably we should follow similar patterns, do communications at frequent occasions, so we know what we are investing to. So I think all these parts can help to clear. And also the fourth part is the technology part. Very interesting example that I want to mention for the green assets RWA issued on Conflux. It's actually a battery swap station for motorcycles. So we work with Ant Financial and Ant Technology. Ant Technology actually have these IoT devices attached to the battery swap stations. So they are monitoring the subscription status and battery swapping operation status of those underlying assets. So they know whether it's operate in a healthy status. And also they have a designated financial account at Alipay to collect the pay from all the subscribers or the one-time users for the battery swap from those motorcycles. So they first collect the money and pay the dividend and the principal to the RWA holders, and then they give the rest to the operators. So with both financial and also the operation data monitoring and controlling, the technology also helps to maintain the healthy status of the RWA underlying assets. And they also use Oracle to continuously push the data on-chain to allow the investors to monitor the situation. So I think all the technology, the financial principles we follow, this could all help to solve the issues of the complex of the more complex financial securities. Thank you.
Thank you. I guess a question for Kate. As an infrastructure lead and former lawyer, if the bridge between the physical asset and the on-chain token is a centralized entity like an SPV, isn't the blockchain just a very expensive database? Where is the frontier in decentralization?
To keep my answer short, because I think we're a little bit running out of time, I think no, it's definitely not just an extensive database in the sense that right now, in an earlier example I gave, blockchain pretty much enable, let's say you can purchase a fund and then it can be a tokenized fund, and then you can use that as a collateral. You can possibly put that into AMM DEX, collateral for your perp DEX positions. So in terms of not just timing and market efficiency, especially cross-market interoperability, in that sense, in that direction, we are getting there, making things extremely efficient. That itself enables much more different use cases, loopings, stacking strategies. But in terms of the legal risk remedy side of things, I think we are getting there with earlier mentioned as well, proof of reserve that streamline collateral position of some tokenized assets, underlying positions, almost real time on chain. But it takes some work if the rails want to connect further legal side of things, trustee, setting up of entity. I think there are innovative projects in the US where there's DAOs that happens on chain that's in progress. But in the closer we touch legal, I think the more work needs to be done. But at least for now, the entire industry is progressing towards that direction.
I guess a closing questions for our panelists. Anybody can feel free to pick up. If the yield on T-bills vanishes tomorrow, which RWA sectors do you think will remain viable? Is it private credit, tokenized gold, tokenized cross-border payments, or any others? Feel free, anybody who wants to pick it up.
I guess I can start first. For me personally, I think on-chain remittance or the efficiency enabled by the blockchain in terms of cross-border payments, be it crypto card or on-off ramp or just paying your PSPs, because that, I think a lot of us here would have used it and enjoyed that side of efficiency. So I think even without the yield, that in itself, it's a real utility that it's really an unlock for me, at least personally.
I have a pretty straightforward answer. Just let the market bloom. So the market will do its picking. So what we do is we bring the assets on chain and let the market do its work.
I have my own theory. My theory is built on how the world is actually shaping up. So I think in the short term, commodity actually can become a very popular RWA assets going forward. Gold is a very apparent trend given it's in the bull market. And the central bank is accumulating gold. And people from the crypto world actually are buying into the gold tokens directly in exchange. But I think maybe, let's say, copper, still, these commodities can be also popular given the world is actually going to a more wild situations. The countries might want to pile up more commodity for defense reasons. So, and all those commodity could enter a bull trend. So it could be an interesting thing to unfold. And the other thing for the long terms, I think I will give a very bold guess, which is electricity. I think Bitcoin is actually a very early symbol sign of how electricity manifests in currency mode. And going forward, everybody knows AIs, Bitcoin's minings, and maybe robots and EVs, they all eat electricities. And US is now running shortage of electricity, and they even import high voltage electricity transmission technologies from China, right? And going forward, China probably has the world's largest electricity storage, transmission, and producing, and also technologies. And if China wants to make its own currency the anchor of the world, what can be the anchor? It will not be gold, and it will not be oil. It will be electricity. And how to make its national debts relevant to the electricity itself and make the electricity yield to become of their national debts instead of anchoring its currency value back to oil or gold. That could be a new way because all the new technologies are reliant on electricity. However, the problem with electricity RWAs is that they are not liquid, they are not standard, and they are fragmented. How to make it a united asset? How to make it a unanimous unit for all over the world to trade around it and make it a large, such big market like US Treasury market could be a very big market for many years to come. Thanks.
Thank you all. Thank all you guys for your great insights. This is.
There's one. Oh, okay, all good. I will speed run this. I think if you look at the different asset classes on chain, they are all very idiosyncratic. They have their own, different caveats. In that regard, credit assets basically repriced mark to market over the last year. I think at Plume, at least for myself personally, we're extremely bullish on option strategies as a next leg of what this basis trade looked like, CLOs. Things of that nature. But I think to expand on what JJ was saying, basically let the market, bring the assets on chain, find the innovation, and then fundamentally from our perspective, have the best assets to select and to deploy into and to use. Yeah.
Thank you guys for all your great insights. This is the end of the panel.